When we look at the market right now, I think there's a couple things we're focused on in the Hartford Dynamic Bond Fund. The first is that credit spread valuations across the board appear quite tight. There's still some opportunity in markets, more sector and individual company specific that we think we can take advantage of. But overall, we think having a lower credit risk posture makes sense. Really, the reason that we've decided to move the portfolio that direction is that we are seeing a lot of things that folks were worried about a year or two ago, things like a weaker labor market, lower oil demand, some signs of credit card charge-offs from some of the larger credit card companies that point to sort of a weaker economy going forward. And so against that, we have tighter credit spread valuations. So that's really a key tenet of our outlook right now, is we don't think you're really getting paid to take a lot of credit risk right now, which is leading us to favor lower credit risk overall and up in quality, meaning more investment grade than high yield in the fund at the moment. For market risks, I think the thing that we're focused on the most right now is really just this idea that the long and variable lags from Fed tightening, it took a little bit longer this time, but we're actually starting to see the impact of Fed tightening really show up in the economy. We're seeing that in less hiring, looser labor market, less inflation. We're seeing trade down by consumers from more expensive goods to cheaper goods. We're seeing the oil market, trade off a little bit, citing that there's just less demand, both in the US but also globally potentially. So really just trying to be open to this idea that the economy is finally slowing a little bit and that there's actually an increased chance of a recession in the forward 12 months than maybe there was in the past 24 months. And we don't really see credit spread valuations reflecting much risk of that. So I'd say that's the thing we're most focused on in terms of taking cues going forward in the Hartford Dynamic Bond portfolio. Really just want to see, how the economy evolves over the next few months. In terms of opportunities ahead, I think I'm looking forward to market volatility. I think there's a lot of cross currents in the market right now. There's a lot of geopolitical volatility. There's a lot of uncertainty in terms of the political outcome in the US. I think the trajectory of the US deficit and fiscal spending is potentially something that could create volatility ahead, and we're definitely positioned to take advantage of volatility. Second thing I would say we're excited about, and this isn't necessarily something we think we can position the portfolio to benefit from today, but I think there's a really interesting story in the US with respect to the amount of infrastructure, whether it's data centers or nat gas fired plants or small modular nuclear reactors, to really support the build out of the electricity demand that's required to meet what people think AI will be. I think that will create opportunities in the utility segment, in the energy segment, and really will buoy sort of like structural investment growth in the US for quite some time. So we're really excited about that topic. And the final one would just be, I do think while we're concerned about the rise in the unemployment rate, I think that there's an opportunity to sort of roll up your sleeves and really try to understand on how we got here. And I think a big part of the reason why unemployment rates have moved higher is because of the impact of significant immigration in the last few years. So when we look at foreign-born unemployment versus native-born unemployment, it's really the foreign-born unemployment statistics that are moving higher. And I think the data historically would say that when you have periods of immigration into the US, it actually takes a period of time for them to integrate into the labor force. So I think that can be thought of as sort of a labor supply shock. So I think if I had to paint the bull scenario for the US economy, it's that the unemployment rate isn't going up because people are losing their jobs. It's just that there's more people looking for work. And that's actually a good thing in the economy for the long run. So we're not necessarily willing to trade or invest along that narrative just yet in the Hartford Dynamic Bond Fund, but that's something we're continuing to work on that we think is a little bit of a differentiated insight versus just saying, the unemployment rate has moved higher, so this is bad.